What if you could own a piece of some of the most successful private equity firms? Not just be an investor in their funds, known as a limited partner, but actually own a piece of the firm themselves. This is known as a GP stake, or a general partner stake, where investors purchase a minority and passive interest in a private equity or private credit firm. This allows investors to sit shoulder to shoulder alongside the management and participate in long-term success and growth of the firm itself. As trillions continue to flow into private equity and private credit, these firms will reap the benefits. And as they grow their assets under management and the corresponding revenues, the GP stake owners will come along for the ride. Over the past decade, CAS Investments has become one of the largest allocators in GP stakes in the world, and we'll unpack why GP stakes have become an increasingly popular strategy. Over the last 30 years, global private equity as an asset class produced average annual returns of 15.6%, while the S&P 500 produced 8%. With these performance numbers, it's no surprise why the world's deepest pockets, sovereign wealth funds, endowments, and the ultra-high net worth have poured trillions into private equity funds. From 2008 to 2023, the total global allocation to private markets doubled twice and are projected to continue to grow at a rapid pace. This trend should benefit the top performing asset managers who receive an outsized proportion of new assets under management. Naturally, those who have done well will be rewarded with more capital from investors. The firms typically command management fees between 1% and 2% annually, as well as 10 to 20% or more of the profits. Let's look at a hypothetical 2 and 20 example. A private equity manager with a $1 billion fund charges 2% in annual management fees. That's $20 million per year that is contractually obligated for many years to come. Let's say that fund doubles from $1 billion to $2 billion. This means there's an additional $1 billion in profits, and the manager is entitled to 20% or $200 million in performance fees. Since most firms manage numerous funds and launch new funds every 3 to 5 years, you can see how businesses can become extremely lucrative. This is where GP stakes can stand out as a superior form of diversification. By owning a GP stake and moving up the ladder to the position of a general partner, one inherits what we call vintage diversification. Since a typical firm manages numerous funds or vintages, the firm earns revenues from their entire lineup of funds, past, present, and future. If one specific vintage or fund does not perform as well as expected, it's less damaging to the firm. The same can be said for the minority partners or GP stakeholders. Let's take it one step further. Owning GP stakes across multiple firms can offer additional diversification. Different asset management firms tend to focus on different industries and geographies, from consumer tech to infrastructure to real estate to healthcare to aerospace to enterprise software and beyond. And while many of these firms are located in the US, some are located or have offices across the globe, providing international opportunities as well. The bottom line, a portfolio of numerous GP stake positions offers a highly differentiated form of diversification for those who want broad private equity exposure. Now, a natural skeptic might ask, why in the world would a successful private equity or private credit firm sell a piece of their business? It comes down to growth. There are almost no exceptions that the world's fastest growing businesses will require an infusion of growth capital at critical junctures in their trajectory. Whether it's to hire new staff, increase R&D spending, or acquire another company, the reasons will vary. In the world of private asset management, the need for growth capital is a result of a customary practice called GP commitments. This practice means the firm itself will contribute 2 to 10% of their own capital into each and every fund or vintage they launch. This shows their clients, the limited partners, that they have true skin in the game. These commitments can amount to tens or even hundreds of millions in each fund they launch. Now, in practice, this approach becomes very cash intensive as the firm becomes more successful. If, for example, the firm launches a new fund every 2 to 3 years, and each fund is larger than the last, these firms can easily run into a cash crunch, especially since it can take 5 to 10 years for each fund to fully liquidate and return the rewards back to its investors. Ironically, they become victims of their own success. The better the firm does, the more funds they raise. the more of their own personal capital they must come up with to invest alongside with their clients. This is where a well-timed sale of a GP stake will provide growth capital needed to maintain or increase the velocity of the business. Keep in mind, when a firm sells a minority interest GP stake, there is a clear use of proceeds established. This is never a cash out and sit on the beach sipping pina coladas situation. These investments are structured with alignment and are meant to add fuel to a rocket already in orbit. The GP stake investor wins by owning a piece of a high-quality operating business, and the firm wins by using the proceeds to increase growth and enterprise value for all. We invite you to learn more by visiting cazinvestments.com.